was sensitive, where we are likely starting before we get to individual names, etc. Voltamp, I think that 8% block has changed, equity has changed hands, 2% lower on Voltamp. So 76.20 or so is where that is trading at. It's largely all in the green, and you can spot a lot of IT on one end. Remember, the IT index has sold off pretty hard on Friday and yesterday as well. Of course, I mean, it's been underperforming before that. On the other end, in terms of what's down, there is Bajaj, Eternal, etc. So, but overwhelmingly in the green. And of course, that's the IT index with about 1.8%. I'm assuming largely propelled by what's happening with Infi. Surbhi.
Absolutely. So Infosys 3% higher, Wipro's 2.5% higher, HCL Tech 1.5%, Tech Mahindra, TCS. I mean, it's just gotten the whole sector excited, saying maybe other companies will follow and return more cash to shareholders like Infosys is planning to do. Remember, the board meeting is on the 11th of September and we'll have more details then. Beyond IT, HDFC Bank is a good support. Stocks up about 0.6%, 0.7% right now. L&T is another heavyweight that's providing some cushion today, 0.5% higher. So looking pretty decent. After that, it fizzles out. The only stocks that are down are some of the consumer and auto names that are cooling off after the big run-up that they've had. So Bajaj down by 1% or so. M&M is down about 0.5%. Titan, there's also Lever, which is showing a smidge of red. Reliance is absolutely flat, so it's not really contributing. Ditto for ICICI Bank, largely on the flat side. But it's IT on the way up. Trent is recovering after the drubbing yesterday. Trent was down quite a lot. It's up about 0.5% at this point in time. Nifty around 70 points higher, largely all thanks to IT.
Two stocks that have been big underperformers are finding its form in the month of September itself. Prime Focus up 30% now for the month of September. Precision Camshafts, there was that talk about them trying to do something on the electric vehicle side. Retrofitting is something that they've been looking at. I think they're selling one of their assets or writing off the asset in Europe. So Precision Camshafts is the other one that's up close on 7%. And for this month itself, that one's up more than 35%. So big up move is what we're seeing on that name. IOL Chemicals, that's the other stock that was higher in yesterday's trading session. It's seeing some follow through. RailTel bought a small order. Street likes it. So that stock, in fact, is holding up well in the green. On the flip side, a couple of stocks are coming for some profit taking after the big run that we've seen. GMDC is now down close to around 4%. MobiWik, that's another one that's coming for some profit taking. Remember, both these two stocks have had a one-way run. Voltamp, you already mentioned, is lower. And Ola Electric, after dancing away closer to around 70 rupees, last few trading sessions, there has been supply that's resumed. So that one now has just breached the 60 rupee mark. So I think that's another stock that you should be keeping on your radar, whether or not that dip that does get bought into. But Prime Focus, clearly the stock of this month itself. And TBO Tech, we had spoken to the management yesterday. Remember, post that acquisition, the stock has seen a big run. In fact, yesterday, intraday, it did see some profit taking, but it's moving back up. The reason being, the acquired asset will increase their revenues by close to around 50%, right, and EBITDA by close to around a third.
Well, so TBO and actually Prime Focus, right? Two names which have done very, very well. Right there on the top of the list. So 76 points on the Nifty, 24,850 is where we are at. And we should have some of the buzzing sharp movers at the bottom of the screen. So, Prime Focus again. IOL was a big mover yesterday. It's up 4%. Precision Camshaft, I think we just mentioned 5.5 higher here. RailTel out of the blue. I mean, it's not done very much last few weeks now, 3%, but it's got volumes. Action Construction Equipment, that's up about 3%. So you got lots of these decent, well-tracked, well-owned names. Force Motors, today, actually, Force Motors sold one-way move. It's still up like crazy this year so far. But then it had a pretty meaningful pullback as well. Last 2 days, it's trying to come back up. Taj GVK is up about 4.5%. Policy Bazaar is another one which is up about 2% or so. So yeah, I mean, lots of names, volumes. If I go down the list, then start to thin away a little bit. NetWeb is another one of those movers, right? I mean, it has gone up like a rocket over the last 5 days, 6 days. Today, it's down 3%. It's got the second largest volumes on the downside, NetWeb. And Mosship is another name which has gone up like a rocket. It's down 4.5% today. Again, third largest volumes on the NSE. And, MIC Electronics, MICEL, we highlighted this yesterday again, these are all, shooting stars. But we'll see if they are short-lived or durable. But this one is coming down 6.5%. Fourth largest volumes on the NSE. MobiKwik is another one, which Hormoz highlighted with lots of delivery, etc. stats. 50% this month. MobiKwik is down about 3% right now coming through. So lots moving. We'll get you more in a bit. Sandeep Bhatia is with us, Managing Director, Head of Equity India, Macquarie Capital. Sandeep, great to have you with us here. Thanks very much for your time. Your view broadly, and I'm just paraphrasing or just summarizing your views, that you've been a little cautious at the margin, right? On the back of a bunch of things. And it's kind of borne out because as far as individual stocks go, something here and there is always there. But at a broad level, the feedback is, people have not really made a lot of money. Over the last 3 months, 6 months, maybe even 1 year, we've been kind of flattish. Do you think there is more time correction ahead of us, or you think, ingredients are coming into place and we perhaps in short order should reverse some of this negative sentiment? What's your sense?
Yeah, I would agree that we're still in the slow burn phase of this market. I think the GST cuts which have been announced are welcome. I would actually believe that the GST cuts will do more benefit for the economy than the income tax cuts which happened in the Feb budget. Because the GST benefits a wider section of the population. It's around spending, and it's not necessary that some of the income tax savings will be spent. They may be saved. So all told, GST move is actually better than the income tax cut. But if you see the current picture, we are in the Shraddh, Pitru Paksh. So I think consumption will still broadly be weak till 21st of September. So this quarter is not going to be good. While we saw last quarter come with good GDP growth, we'll see actually a downtick in terms of the number from the high that we saw in the previous quarter. So all told, it's still a slow burn. The only thing I can visualize is a good festival season. And if we see that, I think October to December markets will see another rally. But on the whole, we are still on high valuations. We still face uncertainty on tariffs from the US. We also are in a very geopolitically volatile region. We saw what happened in Nepal yesterday. So all told, it's still a slow burn.
Okay, slow burn, so still have to be a little cautious, take that point. But Sandeep, I really want to congratulate you on the call you made on autos. And I remember, I think we spoke very early in August, much before the Prime Minister's speech from the ramparts of the Red Fort. And you said auto as a sector is looking interesting. And at that point, your thought was more centered around the fact that we're getting rate cuts. So, maybe it gets people to go out there and buy. Since then, individual stocks are up anywhere between 15, 20, 25% in some cases in the last 1 month. So how much of the excitement and, this pop, how much of it is in the price? Or do you think the GST cut, because it's permanent in nature till the next round, or do you think that it really turns something, especially, say, for the passenger vehicle space, maybe for stocks like Maruti or Hyundai, which have been totally bombed out?
I would actually think that the GST cut in the auto space gives it a lot of legs. I also believe that eventually this small engine capacity cuts have to go. Now, whether it takes 2 years, whether it takes 5 years, I don't know. But GST in autos should be uniform across size of car and across engine capacity. Maybe that will take a couple of years before it comes. But in the near term, there is definitely a big impact on model cycle. I expect both Maruti and Hyundai to benefit from the GST cuts, and also from the fact that there is a model cycle impulse, which will drive people to the showroom, which will drive people to buy cars. So to that extent, all the three manufacturers, whether it's M&M, whether it's Tata Motors and Maruti and Hyundai, all of them will see benefits, and especially vehicle manufacturers which have new models coming in. I would definitely think that Mahindra has benefited a lot from this. I would expect Hyundai and Maruti now to also come through in this on this pulse of new model and new launches.
All right. Hi, Sandeep. Good morning. And I also recall, on autos, you were positive. That's played out well. So good on you. The other, industry that you liked was the hospitality space. I recall us chatting the last few times actually about hotels. And there seems to be no let up. A couple of conferences that I got a sneak peek into. I was, hearing those that are heading some of these hotel chains, and they are sounding extremely optimistic. Would you share their optimism, or do you think after the recent run, you believe that, maybe in fact you're not as bullish as what you were earlier?
So structurally, we are positive on the hotel sector. I think now in terms of valuations, as we are cautious with the market, we just have to think about valuations. If your holding period is more than 2.5, 3 years, then you can definitely continue to be extremely positive on the hotel sector. We have to look at what is the mix of new properties coming through, whether these are big capex investments or these are existing hotels which are taken over under management control. What's the capital efficiency of these new projects, and so on. So all told, I'll be positive, but not the kind of run which they have seen in the last 12 to 18 months. That needs to moderate.
Yeah. What runs very fast, what doesn't run is crawling, right? That's the two-speed state for the market. In terms of really out and out, down and out kind of spaces, if there are any, Sandeep, and typically that is the time to kind of sort of focus on it instead of trying to chase things higher. Anything left out there of interest to you?
It's a bit of a tired sector, but banks can actually do better. They have not been down and out per se, but they have not been the best in the last couple of months. I think we could see another rate cut. I think consumption is going to come back in this festival season. I think some of the banks will get their mojo back, and well-managed banks look interesting. So I think banks definitely look good, and especially in a geopolitically volatile world, export sector remains a bit of a question mark. So domestics like autos and to an extent banks and, as I said, hotels all look better placed on the whole.
Insurers, Sandeep, any thoughts?
Insurers, have to go through this margin hump in terms of the GST cut, input tax credits, and so on. So yes, longer term that's fine. But in the near term there is this GST impact and input tax credit impact which you need to pass through.
Internally, just one last from my side, Sandeep. Internally at Macquarie, as a team, is there? What do you think? How long before we get a tariff truce with everybody's got their thoughts, theories, etc. But I'm just curious.
I'm not privy to what the White House thinks.
No, nobody is privy, Sandeep. Yeah, but that doesn't stop people from. It's all about looking ahead, right? So is it short-lived? Is it longer? What's your sense?
So, if you look at the political calendar, and I don't think people have forgotten that we have a very heavy political calendar in 2026, starting from elections in West Bengal and also in Tamil Nadu, which are two big important states for the BJP. I think they want to do this before March, because after that, the political calendar is extremely heavy with state elections. So logically, it should be between now to March that it should happen. But of course, the stars need to align, and things need to fall in place. But because 2025 was a very light political calendar, and we have not had much impact. There's a Bihar election in end October, November. But other than that, we actually forgotten the politics. And I think to come 2026 and 2027, the state election calendar will be very important and will have an impact both on policy, will have an impact on the government's preoccupation.
Interesting, Sandeep, since you're mentioning about that. Mr. Modi has held its ground. He has said clearly he wants to protect everyone here in India, particularly the farmer community. So otherwise it would be easier, for India to approach United States, try to arrange a dialogue, because you don't know what Mr. Trump is going to do next. He'll put it out on X or some platform that, the delegation approached me, they really wanted me to give in. So I think it has to be handled very, very carefully, because you have a Bihar election That's, just around 2 months or so, less than 2 months away. So, a little bit of a tricky situation. Otherwise, a phone call from Mr. Modi to Mr. Trump could have been on the cards. I think that will have to wait a little bit, or a lot of thought will have to go into it because of the man we're dealing with, Mr. Trump.
Yeah, that's we never know. Just have to wait and watch. Never second guess what the White House is up to next. But two quick questions from me, Sandeep. One is, okay, let's take IT, and then I'll ask you the market question later. IT. Now, Infosys, you would expect the company, I think the market would be far happier if it was a very great tactical acquisition or something pro-growth, but what we've got is a buyback announcement. Would you look at buying IT stocks just because at least the valuations are maybe more comfortable now and there's a cash play, there's a defensive play? What are your thoughts?
So we are cautious going into the near-term numbers for IT stocks. So you should have a 3-year time frame for IT. Then you can probably look at them. There's a lot of moving parts in terms of the US and whether it makes any other further moves. I don't expect, actually. So I'm not in the camp that things will get worse as far as the Indian IT sector is concerned. But yes, I mean, you should, as I said, you need a slightly longer time frame, at least 2.5 to 3 years.
Okay, so have a longer term time frame if you are venturing into IT stocks, traditional IT services, that is. Finally, Sandeep, the point on the market itself, and when we spoke earlier, you had a view that there will be this time correction lasting. Now that we have another big stimulus boost in the form of GST, where does that leave us with expectations of a bumper festive seasons, the earnings pick up, and eventually the market picking up? Where are we on the whole trajectory?
Well, where are we on the whole trajectory? If the markets were 10 to 15% down, then we would be at the cusp of a run. Because the markets are not down as much, though they've been burnt on a slow burn path. It's a combination of whether we really see a big earnings surprise. And as I said, I don't expect the September quarter numbers to be a big earnings surprise. October, December, festival season logically should be good, and I'm actually optimistic for a change on that front. But even then, whether we see that continue in terms of the tariff issue getting resolved with the US and so on. So we need a couple of, other than just the immediate GST earnings kicker, we need more stability on the economy and some good news on politics before the market can really see a big leg up. So yeah, it's where we are, and and we have to go through this next couple of months slow burn phase. Yeah,
absolutely. Sandeep, good chat, good conversation, and look forward to the next one. Appreciate your time here on CNBC-TV18. Thanks very much. So that is Sandeep with his thoughts on the market from Macquarie. Well, what we want to do is quickly play out this specific portion from the FM interview that my colleague Rahul sort of conducted. And this is essentially with regards to Finance Minister Sitharaman essentially reaffirming support for exporters. The most hit sectors like textiles. And she basically promised a package for exporters soon. Basically saying that we will not leave them in a lurch. Listen in.
There is a package which consists of very many different ways in which we want to help them. So we'll wait for the cabinet to clear it. But there is something coming to help them so that this tirade of the tariff is something which they can face. And also suddenly having to look for newer markets is also a challenge. But we'll have to help them out on that. But we really can't leave our exporters high and dry saying it's going to change sooner. We will work with them.
Okay, that's the Finance Minister, promising relief that it would be coming soon for export sectors. Well, with that, let's quickly move on and get the next management on our radar. And we're going to be in conversation with Mr. George Alexander Muthoot, MD of Muthoot Finance. Great to have you with us on the show, sir. Always a pleasure to get perspective from you. So, today specifically, we want to focus on 3 talking points. Number one, of course, given all the changes, the GST cuts, the talk of more stimulus, whether you will be looking at revising your guidance higher at all, FY26. Then we have to, of course, understand how your yields are moving. And then, of course, an outlook on the cost of funds, whether you expect more rate cuts and what that will mean for your margins. So, Mr. Muthoot, let's start with your, broad brush read through of the GST cut, what will happen is, because for a lot of daily consumption items, the rate has come down from 12% or 18% to 5%, people will have more money in their hands. Now, the question is, what are they going to do with it? Whether they'll buy more, whether they'll go back and repay some outstanding loans. What's your, best case read through of this?
Thank you. And first of all, good morning to all of you. You were asking about the GST. So GST.
Yes, and the implications on your business, sir. Yes.
GST number 2 is a big bonanza. It was big bonanza. And I should call it not GST, but see it as a great savings tax. Not GST, no. Great savings tax is what GST 2 is all about. So it's a bonanza for everybody. But of course, directly, we are not involved. We are not affected or impacted positively or negatively by the GST. But of course, all our customers have been impacted. That's exactly what you said. All our customers have been impacted positively because I'm sure all their disposable incomes will be much better, much higher. They'll be able to spend more and probably save more also. So I think that's a big boost to the spending, etc., which will have an indirect impact on maybe the people who borrow and who are able to repay easily. Yes, that is the good impact we see on the GST front with regard to gold finance.
So, Mr. Muthoot, sir, since there's likely to be more buoyancy, it's also a sentiment booster, right? Generally, when I have more money, the propensity to buy more, maybe, borrow more and then, fund my purchases, maybe more gold loans. So would you look at revisiting your guidance? And you anyway had a flying start in the first quarter. So instead of 15%, do you think 20% growth is going to happen this year?
Surely, definitely. Last year, we had almost a 40% growth. As it stands, in the first quarter, we had done well. I think second quarter also, we are doing well. So probably after this, during the second quarter results, when we are announcing, we should certainly give a revised guidance, which definitely will be more positive and probably which will reflect on what is happening and what is going to happen in the next year. Certainly, it will be a better performance this quarter also, and we hope, and I'm sure we'll be able to continue what we were doing last year with regard to the guidance. So I don't want to give a number right now. That number I will give during the second quarter results.
Surbhi, Nigel, when we speak with Mr. Muthoot, it's always so always smile. It's a nice smile, right? And you make us smile as well, sir. It's contagious. So look forward to our conversations. And in August, Mr. Muthoot was with us. He said, 15% is the growth guidance, but would be definitely higher than that.
And now he's saying he'll definitely be better, but he'll tell us a number in second quarter.
But mathematically, it has to be the case, Mr. Muthoot. You're teasing us. You're making us wait till the end of quarter 3. Now you have to revise it. That's a given. The question is how much? What is going to be the new number which we'll be waiting for? I know and the floor is open to you. You can go for it right now. You can give us a broad range and then narrow down on that range at the end of quarter 2. What do you think?
I don't want to do that right now anyway. See, our job is to run the company well. This is a good time for the business. The gold loan sector is doing well. The demand is very much there in all the sectors, wherever it is the outside the rural sector or in the cities also. Demand is definitely great. More people are getting attracted to this. So now priority now is to actually do the business better, grow the AUM, and that is our priority. We will do that. And I think guidance, etc., is just a number which I'm sure we have been doing well. We should be doing well there also. Guidance for the profit, guidance for the AUM, I'm sure it will be positive. As it stands, it's positive. Even the regulations which came are quite positive into this sector. So the gold loan sector definitely should do better. And the demand is also great.
Okay, we won't push you any further. We'll patiently wait for second quarter, but it is looking good and definitely a lot better than what you've said in the past, which was 15%. Since we were talking gold loans, sir, our colleague who tracks the company, Gaurav, pointed out that there were reports indicating, I think Bloomberg did a report yesterday, that the RBI is asking entities to pull back from subsidiaries having an overlapping line of business. For instance, for you, the parent company is into gold loans and there is Muthoot Money, which also gives out gold loans. I don't know, if have you heard anything of this sort? Is there any regulatory change that you're anticipating on gold loans?
We haven't heard, but if the regulator insists that we should merge it, we should merge it. That's all. We don't want to go against the regulators. Whenever they come, they have not said anything like that till now. We have not heard anything. If at all they say something, that we will follow it. Simple as that.
Okay.
All right,
Anyway,
Mr. Madhu.
it's 100% subsidiary.
Okay, so you don't see nothing big on this front. If it's needed, you'll follow what the regulator has to say. Now, yeah, right. The other point is you have things going for you, right? Gold prices are up. That obviously helps growth. Give us two more numbers if possible. One is on tonnage growth. What kind of tonnage growth can we look at? Because gold prices are moving up, which is obviously helping the business. But on the tonnage side, if you could help us out on that front. And also the cost of funds, that's likely to come down. I think you were guiding for, 30, 40 basis points, a little more than that. So how do we see that flowing through? The cost of funds coming down?
Yeah, I think I should talk about the cost of incremental borrowing. The incremental borrowing from the NCD market, the local NCD market is quite positive. We have been borrowing, we have been getting 3-year funding and 5-year funding at maybe sub 8%. I think that's a good one. Probably that is definitely good for us. 3-year and 5-year NCDs bonds at less than 8% is quite good. That is an incremental cost of borrowing. As far as the bank funding, which constitute about 50 to 55% of our total borrowing, the banks have just recently or just starting to revise or bring down the MCLR. The MCLR has really not come down. So, thankfully, today the bank borrowing cost is still less than 9%, maybe 8.75, etc. I'm sure in the next 1 or 2 quarters, that's also start coming down. The point here is the banks transmitting the lower cost of funding is slow in coming. Probably we should see the bank funding cost also coming down in the next 2 quarters. The third source for us would have been the external commercial borrowing. We did a 600 billion external commercial borrowing last week. The money is in the bank now. So we got, it's fully subscribed. And it is done at 6.45 to 6.35% in the national market. Considering the hedge cost, etc., probably the cost should be around 9% or a little less than 9%. Why we did the international funding is that we wanted to diversify our funding source. We did not want to rely too much on the Indian market, etc. So it is just, though it is a little more expensive, today it constitutes about 10% of our total borrowing. So we wanted to diversify. So overall, we see that the cost of funding is coming down. And as usual, that's our practice, the Muthoot Gold Loan Company, Muthoot Finance practice, that whenever the cost of funding comes down or cost comes down, we pass on the benefit to the customers. So we today, the blended rate is maybe 17.5 or 18. If the cost of funding is coming down, we will pass on that to the customer as and when necessary. We will certainly maintain our spread and our net interest margin. We will maintain that, and to maintain that, if the cost of funding is coming down, we will pass it on to the customer. That is one of the reasons why more and more customers come to Muthoot. Actually, 80% of our customers are repeat customers.
No, absolutely, and you've always maintained that you will pass on any benefits of lower cost of funds. But can you just reiterate that? I think spreads you said will be around 9.5% this year. Given the rate environment and your cost of funds, diversifying the source of funds as well, what does all of that mean for margins this year? What is the range or, a rough guidance on net interest margins as well?
Yeah, net interest margin has been in the range of about 5.5 to 6. I think we should be able to maintain that between 5 and 6. We may be able to maintain that also.
Okay, Mr. Muthoot, we'll leave it there, sir, and look forward to our next conversation.
Thank you. You are all an encouragement for us.
No, absolutely.
I really encourage us to do better and better. That is why we are doing better.
And you do the same.
Keep on encouraging us also.
You do the same for us, sir, and we look forward to our next.
Happy belated Onam.
Ona Shamsagal, sir. Happy belated Onam to you too. Thank you very much for joining us and those greetings. I think, we're going to just look at the market for a quick bit. 77 odd points on the Nifty, 24,850. And it's looking pretty solid so far. And we'll see if there is any change. By the way, market breadth has compressed a little bit. Just look at the advanced decline lines. 1,500 stocks are higher and about 1,100 stocks are lower. So the gap is right there. You've got, I don't think the leaderboard has really changed. It's still the same. Only that precision camshaft, I think we highlighted with a 5% gap up in the morning. It's up 11%. So 543, beg your pardon, 243 on precision camshaft. But I mean, the others, Infi, Prime Focus, IOL, RailTel, these are all there in the morning. Action Construction, Force Motors, Taj GVK is another one. Taj GVK is up 8%. Now it's actually picked up more gains from the first time that we highlighted it. TBO Tech has pulled back a little bit, but it's had such a large move recently. And Engineers India Limited is up about 5% as well. So that's the overall picture as things stand right now. 80 points on the Nifty.
Just one point on Taj GVK. We had, explained this company purely for educational purposes earlier in our segment. We have mid-cap microscope, and there were a few factors why the stock was trading cheap. One was that it's only South focus. The second factor is that, they haven't expanded at the rate at which the rest of the industry has expanded. And the third factor was Indian Hotels has 25% in the company, while the GVK group has 50%. So there was uncertainty with regard to, what's going to happen with that shareholding. So whether or not there's going to be some resolution on that front, that's something that the street will track. But otherwise, valuations were in favor for a 2,600, 2,700 crore market capitalization company with approximately 1,500 rooms by the end of this fiscal. So on that EV per room, actually, it had support, but now maybe something with regard to clearing off of that shareholding pattern. We'll have to wait but the last few trading sessions, the stock has done well. It's been a relative underperformer, catching up in the last few sessions. I'll tell you what, we'll slip into a short break. On the other side, we'll connect with the management of Prudent Corporate Advisory. The company, in fact, had done some inorganic growth. Stay with us. Welcome back. This is Corporate Radar. Well, the next company on our show is Prudent Corporate Advisory. We have Sanjay Shah, the CMD of the company, who joins us. Hi, Sanjay. Good morning, and good to see you, Ben. Well, first, we'll just tell our viewers the three big talking points that we're looking at. Indus Capital's mutual fund business acquisition rationale. That's what they have done. What's the rationale on that? Will the acquisition be margin and EPS accretive? And also, what's the growth expected from Indus Capital's mutual fund business in the time ahead? Thanks a lot, Sanjay, for speaking to us here on CNBC-TV18. And, before we get on with the rationale about this, I wanted to compliment you. I've noticed in the past there have been some filings where you share some part of, of the wealth you're creating via equity with your staff, with your support staff as well. So kudos to you. I've, observed that earlier this year as well. I think in June 2025, if I remember, the quantum was around 45 crores. So good on that. That said, let's focus on the acquisition that you've done. Indus Capital's AUM is only around 2%, I think so, of your total pie. But the PBT margin's around 7%. So tell us, how do you see scaling up of this business and also in terms of profitability?
So thank you very much, Nigel, first of all, for complimenting. And if you look at, specifically if you look at as far as mutual fund industry is concerned, I think we have been always looking for the inorganic growth because company is sitting on a significant cash. And this is the business which has been run by Mr. Sanjay Sanghvi, who is the founder. And he has been in this business for almost now more than 22 years. If you look at the entire business construct, They have been managing roughly about 3,500 families, and the average AUM per family would be less than a crore. And 95% of assets comes from the long-only mutual fund in the equity bucket. So, and then another important thing is that this entire business has been managed by 15 relationship managers who are there in the business for more than about 15 years. So it's a very, very well-structured business. Mr. Sanghvi was looking for aligning the interest with Prudent, and it was a very win-win situation for us. If you look at from the point of view rational, because Prudent has been very, very strong on the B2B side, but we wanted to give a message to the entire mutual fund distribution community also that if somebody who is looking for aligning their interests with the larger platform, then Prudent is ready to absorb them from the point of business continuity and service continuity to their customer and absorbing the existing talent pool. So I think overall, it's a very good mix for both of us, for Indus as well as Prudent. And another important thing is that I think Sanjay Sanghvi will remain as a core advisor to our organization as a strategic advisor.
All right. The couple of factors that the street likes is the MF AUM per client is substantially higher for the business that you're acquiring in comparison to the core business. And also the acquisition, I think, is done at low teens, in comparison to the multiple that the company is trading at. So I think those are the two big numbers. Give us a few more details. Any kind of debt you'll be taking on board, employees, integration, synergy benefits, if you could quantify it?
So I think, Nigel, we have been sitting on a significant cash. If I'm talking about currently, company has 600 crore of cash on hand. And it's an all cash deal. May not be 100% money is going at in a one tranche now. So I think we'll be giving about 85 crore now, and rest of the amount will go in next 3 years time or after 3 years. So the company is not required to borrow anything. Everything is available on the books. As far as synergy is concerned, as I told you, Mr. Sanghvi has positioned himself as a mutual fund expert, and he was selling only and only mutual funds to their customer. So we got a very strong, loyal client base. However, as we all understand that customers' needs are now changing dramatically. So I think the biggest opportunity which we will have would be the cross-selling with the help of their existing 15 loyal team members headed by existing CEO called Mr. Gaurav Gupta. So I think the using our technology platform, our brand, our support, our research, and the multiple product will definitely help us significantly. On the EPS side, it's definitely strongly cash EPS accretive, because I think we are investing roughly about 120 crore, but I assume we'll have a cash EPS of about 13-14 crore. However, if you look at the reported profit, because these 120 crore need to be amortized over a period of 10 years, you may not see significant uptick on the reported profit, because you might earn 15 crore by way of profit before tax, but 12 crore will probably amortize over a period of 10 years. But overall, it's a win-win situation.
Sanjay, great to speak with you. Prashant here. And, we talk about mutual fund companies, we talk about broking companies, we talk about all other companies, but your business has been, as Nigel also pointed out, a true sort of wealth creator. And we don't talk often enough, but that is only because you don't join us often enough. So I hope that this is the start of many. I had a couple of fundamental questions, right? I mean, beyond this acquisition, I was having this discussion with a friend. For a business like yours, where, more and more new investors, right? Money is coming in, pouring in terms of every month we get that data. How much of that is coming through, is the share of direct going higher, Sanjay? And, how should one think about that? Is that a risk? Because on the set of, the clients that you have, I mean, that of course is sticky money in that sense, right? And you will continue to earn a trail. But on new investments which are coming in from new investors, etc., how much is direct, and is that a risk?
Prashant, I think we believe market is poised for a significant growth, and both, whether you talk about the direct or you talk about the advisor-led business, both the business will grow significantly. However, if you look at when we look at our growth, we always look at, are we able to capture the market share in the regular piece of the market, because we do not address the direct piece of the market. In case of direct, Prashant, we need to always keep in mind that all direct is not DIY. They have been either supported by the some RIA or some PMS guy would be using the direct money. So there is a inbuilt advisory cost which is also involved. If you look at average cost of servicing customer is about 30, 40, 50 basis points in the direct side, and what we earn is roughly about 80-90 basis points. So I don't think there is a huge difference between two. However, We believe that today country has hardly about 5.5 crore investors, and this number can easily double. On ground, number of advisors are very, very, very less. Prasad, hardly about 175,000 people are there to advise. Compared to that, if you look at insurance industry, only POS number is more than 25 lakhs. So I believe that a huge scope, and as long as you are able to capture your target segment, which is a regular plan, we'll be very, very happy.
So steady state 15-20% kind of growth visibility is there, Sanjay, for your business?
Yeah, because Prasad, we have roughly about 1,060 crore AUM as of 1,060 crore of SIP against a total AUM about 117,000 crore. So Salana हमारे पास करीबन roughly about 10 to 12% I collect by of SIP, and if you assume about 10% by way of mark to market, so I think 18 से 20% growth on the AUM side and similar growth on the revenue side can be easily assumed without keeping in mind the market volatility, because
without the extra, so that's a very decent, nice breakup. So 12% SIP and then 10% mark to market. So that gets you 20% clean kind of growth visibility for from here. So that is well understood. So just one more thing. There are financial innovation is also starting, right? For example, this new product which is the SIF, 10 lakh investment. From what I understand from AMCs, etc., is that distributors are, they're also, that entire machine will start. Distributors have to be trained about the product for them to be able to sell and distribute, etc. Will all this also be, and this product specifically also be a big growth driver according to you? Will Prudent be doing this?
Yes, so if you look at Prasad, for us, we probably, as we told you, in the 120,000 crore of AUM which we manage, I think the average AUM per investor is roughly about 6.5 lakh rupees. So मेरा मानना है कि my customer base doesn't have an appetite significantly to buy the PMS AIF, but this 10 lakh rupees product is significantly better for us. And I can tell you, we have been doing a lot of efforts to, I think, certify our advisors to get the SIF. Today, country has about 500 plus people who have certified got the SIF license. I think 160 is by us only. So we've been doing a lot of efforts there. And I think next year is going to be a huge driver in this segment, the SIF segment.
Yeah. I know some launches are happening. Sanjay, I've been listening to the whole conversation as someone who covers personal finance. It's been really good listening into you, because you and, of course, the other distributors, the whole fraternity has done a great service as well. And the fact that it can be a profitable business, it's really a win-win. So it is quite heartening. Just want to understand the margins and how they will shape up from here on. The entity that you've bought, that has higher margins than the margins at which you're operating. And now as the product mix evolves, abhi aap SIF mein jayenge, that's 10 lakh rupees ticket size, and it's more nuanced. It is for more nuanced customers. And I'm sure even the industry will push it in a big way. So I'm sure even the commissions there will be probably better. Not sure if the structure of those commissions has been laid out or not, but I think it'll be pretty much how it's been for mutual funds. So as all of this evolves, what will the margin profile of your business look like over the next year or two?
Overall, if you look at last 2 years, we have some pressure on the remuneration side to my team. So I think the operating expenditure on the salary was a little bit of elevated in nature, which might continue for a year or so. However, operating leverage will be significantly in our favor going forward. Coming to the margin, I don't think that the overall top line will now probably plateau. So today, currently, we have a, let's say, yield of about 90 basis points. I assume that with 1 or 2 basis points here and there, I think the top line should get stabilized, and my operating margin gradually should improve. So overall, it's a conducive environment as far as I don't think there is a significant deterioration which will happen, but the improvement will be definitely visible. If you talk about
So if you say improvement in the margin, if we, and this is what our colleagues have been telling us, let's say if we talk PBT margin, then what you acquired, this company, Indus Capital, it's operating at 70%, not sure how. You are closer to 25%. So pick any metric, whether you want to talk EBITDA margin, operating margin, PBT margin, and give us, again, the trajectory from where you are at today. How will it improve? To what level, over how many quarters?
I think you need to look at both the business separately. We are purely into a B2B where we have 34,000 mutual distributors who work with us, and they are all into a variable model, and we share roughly about 65 to 67% of our revenue with them. While this is the B2C business.
B2C, so higher margins.
There you already have the employees who manages the business, and there is a definitely very high revenue sharing with them. So if you look at Prudent, originally started as B2C, we have roughly about 10,000 crore in 120,000 crore which we are managing as a B2C, and this 2,000 crore is added into B2C, which is a high margin for us also.
Okay, so blended company margin, that's what I'm trying to ask. Blended margins for your company, from where they are today, let's say 4-5 quarters down the line, where will they be? If you can share that number.
I haven't worked on that, frankly, because I think yesterday only we announced. So I think blended margin I haven't worked on. But I think it might be a little bit improvement will be visible on the consolidated level.
All right, Sanjay, very quickly, before we let you go, just to clear the air, the entity that you're acquiring is not coming with any debt, right? Because you're just trying, you've got a very, very good valuation. That's why I'm asking you.
No, I think the mutual fund business, it's a business without any working capital requirement.
Cool. No, just want to...
No liability, no issue.
No, Renow's team just wanted to confirm that, point number one. Point number two, your market share in the monthly SIP, it's hovering around the 3.5%. Where is it headed? What's the target you have on that number?
I think we would like to maintain the 3.5% the total, because in the total segment, the direct piece is gradually increasing. So if you look at without direct, in the regular piece, my margin has improved from 4.5% to now 5.25%. And I want to maintain 5 to 5.5% in the regular piece and 3.5% on the total piece.
All right. And for those that were not informed, the reason I started the interview by complimenting Sanjay is because, in June 2025, he gifted around 44 crores worth of shares to a 650 odd employees and household staff. So for those who are not informed, that's the reason why we said good acquisition for your shareholders and, taking care of your employees as well. Thumbs up. Looking forward to chatting up with you, sir.
Sanjay, come back more often. Thank you very much. Good luck.
Thank you.
So that is prudent with perspective. We take a quick, I think what we'll do is we'll go across to Vinay Rajani with a quick view on markets and what's happening, the price action so far, right? So holding up 76 points, 24,850. Vinay, what do you have and what would you trade?
Yeah, good morning. So setup is quite strong. Broader markets have been performing well, though we have been underperforming the Asian markets. As we can see, Korea market is near to its all-time high, and US markets are performing well. In fact, Hang Seng is at 4 years high. So global setup is good. The dollar index is under control. Crude is under control. Only thing is that we need a breakout about 25,000, which is a very strong hurdle. So above which we can expect a short covering by the FIs in the index future. So currently we can say that Nifty is currently into a consolidation phase, but bias is positive, sector specific, stock specific bullishness is there, and in the long side we can keep a stop loss at 24,700. that should be on the trailing basis. So yes, bias is positive, selected stocks are performing well, so with the stop loss one can remain long, and stop loss should be 24,700, and above 25,000 we can see a sharp short covering, and that short covering could take Nifty towards the next resistance 25,500. The stock specific, I see strength building in Adani Ports after a long time. So Adani Port can be traded long around 1367. I would recommend a stop loss at 1348. On the upside, I am expecting a target of 1400. Second pick I would take from the Devyani International. So this stock has given a nice breakout and has been resilient in the downfall in the previous downfall. So Devyani International can be traded long around 183. Stop loss I would suggest at 178, and around 192 should be the target for next couple of sessions. So Adani Port and Devyani International on the long side.
Okay. All right. Thank you very much for that. By the way, you just saw some visuals there, Prime Minister Modi, and I think I saw a glimpse of Mr. Rajnath Singh, Raksha Mantri. I'm not sure. I think there were some other visuals there as well. That was the elections for the vice president, where voting is taking place right now. Votes are being cast. And that's what the visual depicted. For the timing, let's talk about some stocks which are on the move. And one of them is definitely RailTel. RailTel is up 6%. The company's won an order. Let's find out more. Vinny, tell us more. 6% is a decent move.
Absolutely, because they have around 5-6 order wins that have come in, valuing overall total value is around 700 crore rupees. Now, this order is actually come in, these individual orders or letter of acceptances that the company has got is from the state project director of Bihar Education Project Council. Now, there are different orders that are there in this, like I mentioned, right? So, among that, the two big ones, one is an order related to procurement, supply, installation of smart classrooms at the government middle school, which is valuing around 262 crores. Another one is also similar, procurement, supply and installation of smart classrooms at government secondary school and middle school as well. That is of around 257 crores. And then there are smaller orders and ancillary orders related to this as well. So overall, 700 crores order win. That's why the stock is buzzing in trade.
All right. By the way, prime focus at the bottom of the screen, right? 1% equity changed hands once again. It was, by the way, it came out of circuit for a while. It was up 7%, 7.5%, but its limit up once again. So about 192, 30% Friday, Monday, and today, 30% on it for now. Now, IT is what we want to focus on, right? I mean, Friday was bad, yesterday was poor, but there's a bit of a rebound on the back of that Infi buyback announcement. Rima is here with details. Rima.
Thanks so much for that. So first the news, Infosys board will be mulling a buyback on the 11th of September. That's got the stock excited. So after a 20% decline so far this year, the stock is up close to about 3.5%. This would be the company's fifth buyback since 1993. Now, a buyback or any form of a capital return always signals confidence that the promoters believe perhaps the share price at this level may be undervalued or fairly valued. Morgan Stanley, the next question is how large could the buyback be? The last three buybacks were in the range of about 9,000 crore rupees. They were open market buybacks. But remember, from 1st of April 2025, open market buybacks are disallowed. So this time it's got to be a tender buyback. Morgan Stanley says that we see the potential for a 10,000 to 14,000 crore of a buyback. Historically, buyback premium has been about 18 to 25% from where the stock was before, and the total buyback size, to their mind, could be about 1.3 to 2%. The next question is, because the entire IT space is active, who else is eligible for a buyback? Well, of all the large 5 IT companies which are a part of the Nifty, it's only Infosys, Wipro and TCS which have been pretty regular with their buyback. HCL Tech and Tech Mahindra not so. So, HCL has only done 2 buybacks in their history, Tech Mahindra only 1. So the other 2, that's TCS and Wipro, both completed their previous buyback more than a year ago. So the street is saying now it's time for them perhaps to come out and announce a buyback. Back to you.
All right. Thanks very much, Rima, for that. So that's Infi for you on the back of that buyback announcement. We'll take a quick break here. On the other side, Manisha focuses on commodities. So stay tuned. Coming up.
Welcome back. So the equity market is having an okay morning, not too bad. But let's find out what's hot in commodities. We have Manisha with the latest. Manisha, what's top of mind for you?
Well, I'm looking at soft commodities right now, shifting focus because, you're looking at gold prices making all-time highs every day. Silver is surging higher. Metals are doing very well as well. But what is not doing so well really is some of these soft commodities. So I'll take you through 4 or 5 of them. I'll start with cotton because the prices here have constantly declined. There is higher availability that we are working with right now. So when you look at the Indian markets, we are looking at stronger numbers in sense of crop, and then 11% duty is done away with. So imports also are going to be on the stronger side. And it's not just about India, Brazil, Texas, these are the other major cotton producers, also are looking at a strong cotton crop going forward. So cotton not doing well in 2025 till time. The other one to watch out for is rice now. Remember, India has had very strong rice crop in the last seasons, and this season also is expected to be a record number. And then there are inventories which are much higher. And then export numbers are not so good as well. That is because the international rice availability is quite strong. High production in Thailand as well seems to be weighing on to the markets. And this is the USDA report which says that in 2025, the global production is expected to reach a record 543 million tons. So India, Thailand, global rice numbers are very huge is the reason. It's a 5-year low in the international markets and a 3-year lows for the Indian markets as well. The other one on your screen is soybean. Here as well, Brazil is set for a record soybean production. So is US, and that is what is weighing on to the markets. And even as there are some biofuel mandates, even despite that, markets are looking at constant pressure coming in for this one. Brazil is set for a record crop, and then you're looking at China, soybean stocks as well, much on the higher side. 6.8 million ton on what Chinese stocks are is at a March high for this one. Cacao should come in on your screen because that one is trading at a 10-month lows. We did see all-time highs in 23, even 24 was a volatile year, but 25 has seen profit taking. So $7,000 a ton is how cocoa seems to be trading at. There are improvement in supplies from West Africa. Ecuador could surpass Ghana as the world's second largest producer with the kind of numbers that we are looking at. So higher production is the constant impact that we've seen coming from the higher prices as well. And finally, I want to talk about sugar because we're looking at a 4-year lows in the international markets for this one as well. So the raw sugar prices have continued to decline. There is expectation of ample supplies, and then the fund selling pressure also has been on the higher side. And then you're looking at higher production from the top producer, Brazil. India is looking at an 18% jump in sense of sugar production for the coming season. And Thailand, the third largest producer, also is looking at very, very strong numbers. I want to leave you with the final plate which tells you on how many of these international agriculture commodities have done in 2025. So you have wheat prices down 9%, cotton is declined by 5.5%, rice is down by 19%. As I said, 5-year lows coming in for that one. And then other commodities like sugar is down 19%, second straight year of decline for sugar. Cacao is down 38%, and you have seen rubber prices decline quite sharply as well.
Okay, all right. Yeah, for the traders, maybe not such great news, but for consumers, those declines perhaps look good. Lesser inflation. Thank you so much for joining in, Manisha, with that quick analysis. We'll take a break on that note, come back on the other side, and it'll be time for a special segment, It's the Economy. Today, Lata discusses the outlook for banks and NBFCs after the recent tax cuts. Suresh Ganapathy of Macquarie Capital will join in.
Welcome to It's the Economy. Banks and NBFCs remain underperformers despite many boosts to consumption coming from the government and the Reserve Bank. To get a closer view of the impact of the GST cuts in particular, and of course the rest of the impulses on the financial sector, I have with me Suresh Gadapati, Managing Director and Head of Financial Services Research at Macquarie Capital. Good morning, Suresh. Thank you very much indeed for your time. Well, first up, after the GST cuts, we saw Bajaj Auto have its day under the sun, probably for a day or two, and then it's all quiet. How would GST cuts basically impact? Should it not push up retail loans across the board?
Yeah, it should, Lata. I mean, coming from the third quarter onwards, see what's happening here is that so far growth has been tepid, right? And going into the second quarter also, the numbers are not going to be very encouraging. In fact, the bulk of that 50 basis points rate cut, which was done end of June, will flow into the second quarter, thereby affecting earnings. And what we are hearing here is that on the asset quality front also, I think 2Q will be a tough quarter. Not going to see any kind of a reduction in provision. So near-term earnings remain under pressure. Now, it's all a question of hope whether things will recover from 3Q onwards because of GST rate cuts and what could be the implication for the retail loan growth. Near term, there are challenges due to which the stocks aren't necessarily factoring in that kind of optimism.
Would you have any ranking in terms of who benefits from GST cuts?
Largely, for example, all the major private sector banks like the likes of HDFC, ICICI are, of course, heavily involved in the retail segment. Almost 60% of the portfolio comes from retail and therefore they should benefit. Of course, a whole lot of NBFCs, both vehicle finance as well as non-vehicle finance NBFCs like the likes of Bajaj Finance and all should benefit. Stocks have already rallied and pricing in that kind of optimism. So to that extent, maybe one could argue that the current price is more than adequately factoring the optimism coming from GST rate cuts in some of these stocks, I would say. But largely, banks and NBFCs which cater to the retail segment are the ones which are going to benefit from the GST rate cut. Basically, those who are there in non-housing portfolio, let's put it that way. Yeah.
Okay. Got that. Retail, non-housing lenders are going to be the beneficiaries. Why are you so negative on Bajaj Finance? Was it that MSME hit that they announced?
Yeah, look, I think our view here is, Lata, both growth and ROA cannot coexist. I mean, if you indeed want to deliver 24-25% growth, say for the next 3 years, 4 years, then you can't deliver at the current 4% plus kind of an ROA that they report. Because growth at the margin will have to come more from secured segments, which will be margin dilutive in nature. And again, credit cost is unlikely to touch the level seen, which we had seen earlier, right? So it will still remain at 200 basis points, kind of an elevated credit cost trajectory. So there is a downward pressure on ROA. And I don't think the current price factors that possible outcome. That's the reason we are a bit more skeptical on BAF. Not that we don't like the fundamentals of the company, but if you have to look at fundamentals in the context of ROA, which could decline and where the valuations are, I think there could be a downside in the near term.
Okay. What you're saying is that they've lent so widely that hereafter extra lending will either come at a higher risk or at a lower return.
Correct.
That's a view on BAF, and so incremental gains are less. Okay, you recently upped Kotak Mahindra. Can you take us through your argument?
Yeah, sure.
So, up the target price, right?
No, we haven't. We haven't changed our view on the name. It still remains neutral. But what we are telling here is that 1Q was exceptionally bad, driven by margin compressions and credit cost, which of course really disappointed the street. We do believe at the margin, some of these pain points could abate. It's not that it's going to come down very significantly, but at least there is going to be sequential improvement. Note that they also cut the savings rate, but bulk of that happened towards the end of the quarter, and therefore the full impact of that savings rate cut will flow into the flow from second quarter onwards. To that extent, their margin performance should be relatively better. And there is an acknowledgement of some of the issues which are facing them, and therefore the bank is on a course correction mode. Now, some of these things will take 2, 3, 4 years for it to get shown in the numbers, but near term, at least there is a sequential tailwind coming to the stock, and therefore it remains a good tactical outperform in the near term. We do have a neutral perform over the medium term on the stock.
Yeah, I noticed it was neutral, but I thought the price had been upped. Okay, let me come to the very interesting report you wrote around the time when the bank results came out, saying that the best result award goes to City Union Bank. Is that still one of your best buys?
I mean, and the mid cap one, yes, and they will also be big beneficiaries of all these rate cuts, which will eventually, GST cuts, which will eventually have a positive effect on the SME space. They have a very large exposure. Also note that Lata, they are the only ones in the system which has 99% of the portfolio secured. And today there's a greater degree of challenge, as you know, on the unsecured portfolio, but things are still not completely out of the woods. Let's put it that way. So to that extent, they are relatively in a better position, even when it comes to the asset quality. And for a couple of years, their growth was also relatively weak. Because they were going through their own internal structuring and restructuring, and today the base is comfortable enough for them to grow. So all those things work in their favor. Valuations are also relatively reasonable in the current environment, and therefore CUBK still remains a decent pick for us. And I think some of the export incentives which are being talked about by the government on the SME space, again, CUBK having 50% of the exposure to the SME space will also benefit in case the government, of course, decides to tackle on the tariff issue and implements some of those things that they've been talking about.
Okay, the other thing that we keep getting from bankers is that the worst pain of MFI is over.
Yeah.
If that is the case, are you turning positive on IndusInd or Bandhan? I mean, IndusInd has fallen enough for all the troubles it went through. So, and also MFI portfolio for both these banks. On the cusp of something better there?
Yeah. See, Bandhan, we already have a positive view, and we do believe second half will be better. The only joker in the pack is BR elections, Lata, because sometimes around these elections, something or the other happens, and therefore we have to be a little bit more guarded about our base case view of credit costs coming down in the in the MF5 space is also contingent on no untoward activity happening, say in Bihar. And of course, remember, West Bengal also goes for elections in April of next year, right?
Yes.
So we have to be a little bit more careful around the election times, and these are all even risks. It's very difficult to predict. Notwithstanding any of these election related issues, at least the MFI sector should see across the board a reduction in credit cost. And note that since the start of the year itself, a lot of people have started implementing the 3-lender rule. Some of the benefits of that should start flowing into the overall economy in terms of reduced slippages and credit costs, right? With a greater degree of discipline emerging. Now, IIB is a little bit more different, because I think you have to look at the fact that while there could be tailwinds in the MFI space, I think the path towards 1% ROA is very arduous. They will have their own set of challenges. A lot of management related changes will happen, and that path towards 1% ROA being difficult and longer term and fraught with its own set of challenges means that risk reward even now at the current price is unfavorable, and we will be a little bit more skeptical, and therefore it remains an underperform for us.
Okay, still, I guess Rajiv Anand will have to show some mettle.
Yes.
Let's come to the other GST category, which is much discussed and in which you have hardly, you don't have too many buys, the insurance sector. You're surprisingly having a outperform on LIC, where your earnings CAGR is only 9%. And you have an underperform on HDFC Life, where the earnings CAGR for 3-4 years is actually 16%.
Yeah.
Is it that it is too expensive? Is that why HDFC Life is a sell, but LIC is a buy?
Yeah, look, I think, Lata, when you're getting 15% VNB CAGR, the market is paying 20 times VNB multiple, whereas the VNB multiple for LIC is negative because it trades below EV, right? So there is a valuation discrepancy, point number one. Second thing, we do believe that the RBI's regulations on third-party mis-selling of products on the banca front will come through in due course of time, and that will affect definitely people who have a larger degree of dependence on banca. LIC has the least dependence on banca. There are also LIC benefits. So there are some near-term things which are working in LIC's favor, due to which we have an outperform in LIC. I do believe that because of the GST, there will be some marginal impact on the VNB in the near term. First half has been a challenge in general because of the base effect of last year. So all these pieces of puzzle, if we were to put together, we're looking at a relatively a modest year for FY26 when it comes to the insurance space. And that is the reason where the valuations are. We are relatively a little bit more guarded for the life insurance space. And we have a bias towards a low valuation entity that like LIC. And of course, we're waiting for the RBI regulations on the banca front, which will have some impact on the life insurance players.
Okay. I guess Reserve Bank is also holding back since, everyone wants consumption to pick up.
Yeah.
Well, actually running out of time. Very quickly, you don't like any of the fintechs?
Yeah, look, I think PB Fintech is the only player which we do like because at the end of the day, we do believe that if there is going to be more number of players, as you have seen, entering into the life insurance space, if the banca thing goes through, then obviously there will be a greater degree of a dependence or sales happening through the PB Fintech channel. Overall, I think the GST cuts are good from a demand perspective, both on the life as well as general insurance over the medium term. It may not happen immediately next quarter or so. All that will benefit a broker like a PB Fintech. So PB Fintech is a better play in my opinion. And of course, even the Insurance Amendment Act, which talks about the composite licensing regime, that should benefit a broker like PB Fintech better compared to some of the other channels, I would say.
Okay. I'm absolutely being warned. If you can give a one-line answer for this. The positive on banks seems to be that now that MCL and our deposits and all will start repricing.
Yes.
So margins should have bottomed. But on the other hand, the negative we hear is this, are MSMEs now becoming a problem?
Yeah.
Where are you on that? As briefly as you can.
See, first to begin with, Lata, we have done extensive checks, and what we have realized here is that the large banks, when it comes to their MSME portfolio, be it the likes of HDFC and ICICI, are doing very well. I mean, there is not even an iota of stress that they are seeing. Of course, there will be some recalibration of portfolio with respect to MSMEs in the textile space, but they are really fine. So what's happening in the MSME space is the stress currently is visible in the unsecured and also, of course, on the lower ticket size. The larger ticket size, which is greater than 1 crore plus, MSMEs are still doing very well. And I think that situation is at least unlikely to change. So we have to be a little bit more selective there when it comes to MSME stress. The tricky part with respect to the overall banking space here is I still believe market is not pricing in a rate cut happening in the October to December quarter. Because if that indeed goes through, and I don't know, it's your guess, anybody's guess, whether it can be 25, 50, maybe they don't do. But if at all they indeed do 25 to 50 basis points, GST cut will also result in lower inflation by 25 basis points as per some economists, thereby opening a little bit more amount of leeway in the near term. Then there is going to be a shift of the entire margin recovery. So what you thought would happen in 3Q and 4Q will now get pushed to 1Q of next year. And that I don't think the market is pricing in.
Oh, absolutely. And we haven't even spoken about the fact that the bond book has crashed.
Right.
Other income is going to be less. Thank you very much, Suresh. Pleasure speaking with you, giving us a 360-degree perspective. We have to wrap up on Bazaar on that note. Chartbusters up next.